Welcome to the best investment writing, your gateway to the minds of the world's most respected investors. Join us as they unveil the insights gleaned from their tireless research, providing you with invaluable perspectives to enhance your own investment journey.
All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Hello, this is Brian Chingono. I am a partner and director of quantitative research at Verdad Advisors. Verdad is a systematic investment firm with strategies across public equities and credit. Our equity strategies seek to replicate the private equity formula in public markets by investing in firms that are small, cheap, levered, and in the process of paying down debt. Our typical investment across these global strategies trades at 5 times EV/EBITDA, generates a 20% free cash flow yield, and has around 2 turns of net debt relative to EBITDA, with a focus on reducing this debt over time through free cash flow generation. To learn more about us, you can find us at verdadcap.com. That is VERDADCAP.com. Or you can follow our founder Dan Rasmussen on X, where his handle is @VerdadCap. Now let's get into the episode. I'm going to read a piece titled The Dispersion Delusion. And this piece argues that private equity's return dispersion is actually the same as public stocks with similar characteristics. Advocates for private equity investing often note that the dispersion of performance between top quartile and bottom quartile managers in private equity is significantly wider than the range of performance in liquid asset classes. The implication is that private markets are less efficient, that there's a larger role for skill, and that investors in private equity can take advantage of this dispersion through manager selection. According to JP Morgan's Guide to Alternatives, manager selection is critical to strong returns, perhaps even more so in alternative investments. They continue to say that dispersion in performance is pronounced in non-core real estate, private equity, venture capital, and hedge funds, underscoring the importance of choosing an effective manager to unlock the return-enhancing potential of alternatives. While this isn't a new argument, we do think it has been oversold. To start, we could simply look at the outcomes of the largest private equity allocators to see how they do on manager selection. If you aggregate these large allocators' PE portfolios and assume that they're randomly throwing darts to select managers, you'd expect to find that 25% of their managers end up in the top quartile. But of course, they're not randomly throwing darts, so they should do better than 25% in the top quartile. But in reality, you find that the outcomes of large private equity allocators follows a bell curve, with less than 20% of their managers ending up in the top quartile. And separately, in a recent paper, researchers from the University of Chicago, Oxford, and UVA found that buyout firms who report top quartile performance while fundraising have little to no persistence in remaining top quartile in their subsequent fund. Just because a private equity manager reports top quartile performance in their current fund doesn't mean that they will remain top quartile in their next fund. According to these researchers, this means that investors gain little by knowing the relative performance of the current fund when deciding whether to commit to the next buyout fund being raised by the same GP. So if wide dispersion in private equity is attributable to high skill, then either A, those talents don't persist across funds, or B, they cannot be recognized at the time of fundraising. Although to be fair, there was one category where skill persisted among buyout managers, and that was in the bottom quartile, where the worst performers were likely to remain in the bottom. We think a more plausible hypothesis is that the high dispersion in private equity reflects differences in portfolio composition between private equity and public funds. You see, private equity portfolios are quite different from mutual fund portfolios. First, private equity portfolios tend to have about 20 firms, whereas a typical mutual fund holds about 200. Second, private equity portfolios are overwhelmingly comprised of microcaps, while most mutual funds focus on large and mid-caps. Even the median small-cap mutual fund holds companies with market caps about 10 times the size of a typical private equity investment. Third, private equity funds hold highly levered companies, with the median proportion of debt financing being 49% net debt to enterprise value, and the median leverage ratio being 4 times net debt to EBITDA. It's also worth noting that private equity funds have widely varying holding periods, with funds buying companies over a 3 to 5 year investment period, holding each company for 3 to 5 years, and then exiting. The differences between the type of companies that private equity funds own and the type of firms that dominate public equity indices are substantial. Approximately 20% of US private equity funds are below $50 million in size, and the median fund size is around $300 million. So assuming private equity funds have around 20 holdings on average, that would imply average equity checks of just 1 to 3 million among the smallest funds. So at the smallest extreme, private equity holdings are really tiny compared to the Russell 2000 index, where the smallest stocks are around 50 million of market cap. To create a public market replica of the private equity opportunity set, we built a levered microcap universe using S&P Capital IQ's data on all US stocks from 1995 to 2022. To capture the radical size characteristics of private equity in our microcap universe, we set the minimum market cap at 5 million, and we set the maximum at 2 billion. Minimum leverage for eligibility to the microcap universe is 30% net debt to enterprise value. For comparison, we also built a mutual fund universe that contains both levered and unlevered companies, and the minimum market cap there is $2 billion. The difference in characteristics between these two universes is substantial. In terms of size, the microcap universe is $100 million of market cap at the median, whereas the mutual fund universe is 50 times larger at $5 billion at the median. And in terms of valuations, the microcap universe is 1 times EV to sales at the median, which is less than half of the 2.3 times EV to sales at the median of the mutual fund universe. Finally, leverage in the microcap universe almost quadruples that of the mutual fund universe at 4 times net debt to EBITDA among microcaps versus 1.3 times at the median within the mutual fund database. So within the two databases we created, the microcap universe is smaller, cheaper, and more levered than the mutual fund universe. We can see the impact of each of these differences by creating simulations of public equity portfolios that vary in concentration, company size, and timing of investment. The simulations start by randomly selecting a vintage year between 1995 and 2017, then including the 2 subsequent years to form a 3-year investment period. For example, if 2000 is randomly chosen as a vintage year, the investment period will comprise 2000, 2001, and 2002. Each investment within a portfolio is sold after being held for 4 years. This iterative process of portfolio formation and realization is repeated 10,000 times in our simulations to create a distribution of return outcomes. First, let's compare dispersion among typical mutual fund portfolios versus microcap portfolios. As a reminder, in our simulations, the mutual funds hold 200 positions with a median market cap of 5 billion, whereas the microcap portfolios have 20 positions with a median market cap of 100 million. The dispersion between top and bottom quartile returns is 21 percentage points in private equity versus only 8 percentage points among the simulated mutual fund portfolios. But the microcap simulation shows dispersion of 16 percentage points. This suggests that concentration in microcaps explains more than half of the difference in dispersion between mutual funds and private equity. In these simulations, we assume that all stocks are held for 4 years with equal amounts invested in each year. So what other characteristics explain the remaining differential between private equity and mutual funds? Our initial simulations showed that more than half of the excess dispersion in private equity relative to mutual funds is simply due to concentration in levered microcaps. These simulations were based on random sampling. But private equity firms generally do not arbitrarily select their investments by throwing darts. They do apply some selection criteria. So next, we measured the impact of factor exposure by ranking the microcap universe by valuation and profitability characteristics. Specifically, we compared the median returns of private equity against simulated microcap portfolios of 20 stocks that are selected from the cheapest 5% and the most profitable 5% of companies within each year. Within our microcap data, there are typically 30 to 50 stocks in the top 5% of any given year. And the factor-ranked simulations randomly select from this top 5% opportunity set when forming the 20-stock microcap portfolios over the course of 3 years. So at a pace of 6 to 7 investments per year. For context, there are over 2.3 million businesses with more than 5 employees in the United States. So if the private equity industry focuses on top 5% of that universe of 2.3 million businesses, the private equity opportunity set would have plentiful investment targets with over 116,000 firms. This target list represents more than 6 times the 18,000 firms actually owned by private equity today. Therefore, we believe our 5% sampling provides a good representation of the opportunities available to private equity. So now we're ready to compare the annualized returns of private equity against the top 5% of microcaps ranked by value and the top 5% of microcaps ranked by quality, which we define as gross profits relative to assets. Value characteristics appear to have the biggest impact on microcap returns, boosting the median return from 10% in a totally random sample to 18% in a value-ranked sample of 20 microcap stocks. Quality also seems to matter, with an improvement of 4 percentage points in the median return from 10% in a totally random sample to 14% in a profitability-ranked sample of 20 microcap stocks. Private equity's actual median return is somewhere in the middle of this range at 15% annualized. Clearly, characteristics matter as part of private equity's success formula. As University of Oxford professor Ludovic Phalippou has written, buyout firms mainly invest in small and value companies. So we believe it's important to account for both size and value characteristics when comparing private equity performance against public markets. So to test this, we ran our microcap simulations with an assumption that managers rationally choose to concentrate on their best ideas by selecting from the highest ranked stocks within each year. Our simple ranking system prioritizes stocks that are cheaper, more profitable, and more likely to pay down debt. Hold periods were allowed to randomly range from 3 to 5 years, and the pace of capital deployment can vary over a 3-year investment period. We also included a simulation of mutual funds, which ranks on value and profitability, but selects from a universe of larger companies, those above $2 billion in market cap, and that also includes unlevered firms. As a benchmark for pure factor exposure, simulation results are presented before fees. Comparing the actual net IRRs of private equity against the microcap simulation, we found that dispersion is about the same at 20.7% in private equity versus 20.4% in the factor-ranked microcap simulation. Therefore, private equity's dispersion is in line with the random outcomes we would expect to see from volatile portfolios of levered, cheap microcaps. The most notable difference is that private equity managers underperform their simulated benchmark by 2 to 4 percentage points per year, with a median return of 15% in private equity after fees versus 17% annualized in the microcap simulation. This difference could easily be explained by fees. The implication of this result is that private equity's value creation is not sufficient to overcome its fees. While private equity may create value through deleveraging and other management decisions, those benefits appear to be fully offset by fees. The factor-ranked mutual fund simulation, which selects from a different universe of larger firms, including unlevered companies, has lower dispersion of 7% and a lower median return at 10% annualized. With a greater number of holdings at 200, the diversification of mutual fund portfolios dilutes their factor exposure, contributing to lower dispersion. So when comparing private equity against mutual funds, we think there are two main effects to consider. First is the universe effect, where the private equity universe is dominated by microcaps and all companies are levered. Second is the concentration effect, where the average private equity fund holds 20 firms versus an average of 200 holdings among mutual funds. Assuming managers concentrate on their best ideas, cheaper, more profitable companies, we find there is higher dispersion among concentrated portfolios relative to more diversified portfolios. This is primarily because concentrated portfolios have greater exposure to the extreme positive skew of the value factor. Our results suggest that the dispersion in private equity can be fully replicated in public markets, provided that investors focus on buying cheap, levered microcaps and hold them in a concentrated portfolio similar to the portfolio construction in private equity.
If you enjoy the show, be sure to leave us a rating and a review on your favorite platform. You can read investment research like you heard today by subscribing to The Idea Farm's free weekly e-newsletter at theideafarm.com. Thanks for listening, friends, and good investing.